Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. The biggest influence on the market today is rising rates, right? If we take a look at the short-term rates, whether you look at the 2-year yield, the 1-year yield, or the federal funds rate, you see a direct inverse correlation between rising short-term rates and the stock market. And that's quite concerning because a lot of very intelligent, a lot of very smart people claim that this bull run from 2009 all the way to 2022 was a direct result of low yields, one very soft tightening cycle, and most importantly, QE, quantitative easing, asset purchases that systematically pushed rates artificially lower and was asset inflationary throughout the past decade. Now that inflation has broken out, if we put up the inflation rate, clearly we've broken out here. A lot of people are very concerned that this comes with a new era of tighter monetary policy, reversing the entire bullish process that we had between 2009 and 2022. And with the Fed meeting coming up tomorrow, we're seeing concerns spike to an all-time high as investors begin to brace themselves for this type of major capitulation event. So we're going to look at that in detail in this video. Is that something we should expect? Are these concerns regarding the end of the secular bull run being fueled by the Federal Reserve's tightening monetary policy? Are these legitimate? That's exactly what we're going to cover in this video. If you are new here and you are interested in learning about the markets and following these crazy markets with us, make sure to smash that subscribe button. Also, if you enjoy this episode, don't forget to click on that like button. And now without further ado, let's get right into it. So we are around 9 months into the tightening cycle. Just objectively, you can definitely say that a large part of the tightening cycle is behind us. If you take a look at the 2-year yield, it's risen incredibly quickly over the past few months as investors have priced in a more hawkish monetary policies. A lot of this is in the market right now, but the question is, could we still see stocks snap back to reality because equities perhaps have not fully priced that in? Now let's take a look at where the 2-year yield currently is. It's at around 4% right here with a tremendous rise just over the past couple of weeks. Now, what's interesting is that this is around the target rate that a lot of the Fed members have talked about. 4% is what they're aiming for the end of 2022. So it's interesting to see that the bond market seems to be agreeing with that and has priced that in. If we take a look at the target rate probabilities for December of 2022, so for the end of the year, we see that market participants are generally expecting the target rate to be between 4 and 4.5%. Right, and these are probabilities that are derived from the Fed futures contract, right? So that's what investors are currently pricing in. So we have this situation where the bond market is pricing at 4%. The Fed is saying that they're aiming for around 4 to 4.5%, and Fed futures contracts also agree with that 4.5% target. Why am I saying all this? Because it doesn't seem like there's a big disconnect right now in the market. Everything seems to be in line with around 4%. No disconnect, no discrepancy can be identified in terms of market expectations. And I think that's very important because that's definitely not something that we had at the beginning of the year back in January 2021, where the Fed had already announced that it was beginning its hiking cycle. And yet clearly equity investors were not pricing anything in. After an 8-month period where the Fed has clearly been the most important topic of discussion, you can say this is a different situation to the beginning of 2022, where investors just didn't believe what the Fed was saying. Here, we've had an 8-month period where equity investors have been disappointed by the Fed again and again. If we take a look at this article that we posted this week, we showed this chart here of the put call premium. Look at what happened over the past couple of weeks. We've seen the put call premium spike to above 2. So that's telling us that investors are paying a record premium to protect their portfolios ahead of this Fed meeting. So to me, that really is further proof that this Fed hiking cycle is extremely well documented. People are very aware of the fact that the Fed is a tail risk to the market and that it is having a bad influence on assets. And so when I see that type of situation, the first thing that comes into my mind is anyone who has been concerned about the Fed, who thinks that this is the end of the bull run because the Fed is hiking, they've already sold. In other words, this tells me that there's perhaps nobody left to sell because of the Fed tightening cycle. Now, perhaps another problem is going to come in, like a collapse in earnings, a big recession, right? And that's another narrative out there that we're heading into a recession and that's going to drive the next leg lower. We're going to discuss that in just a second, but I don't think that's what this put-call ratio spike is about. This is because investors are scared that the Fed is going to be more hawkish than expected and cause a major capitulation move down. And in just a second, we are going to discuss what the data says regarding that, whether or not that is actually a high probability scenario. But before I go ahead and do that, if you're so far enjoying this episode, if you're learning something new, if you appreciate the time and the effort that goes into making these videos, don't forget to smash that like button as hard as you can. It really helps our channel grow and reach new investors. So based on this put call premium massive spike, a contrarian bet here would be to say that the markets are going to rise no matter what the Fed says in their meeting. However, we are not mind readers of the Fed. We don't try and base our investment strategy based on single meetings. We think that's a fool's game because the algos step in, create massive volatility spikes, and they can whipsaw you around. So the initial market reaction to the Fed, we don't necessarily want to pay attention to that. But this does tell us that the consensus right now is that the Fed is going to make the market collapse. Just like the consensus in 2020 was that we were going to see an economic collapse because of the pandemic. In 2016, it was the beginning of the tightening cycle. After years of zero rate policy, investors were incredibly skeptical that the market could rally with a Federal Reserve that was tightening monetary policy. And in 2009, consensus was that we were heading into a Great Depression that would last 3 to 5 years, similar to 1930 to 1935. Of course, all of these consensus opinions ended up being completely wrong, completely out of touch with what was actually priced in and what was actually going on. And that's one of our core objectives at gameoftrades.net, is to make sure that you are aware of what the consensus trade is at any point in time. But that's not a hard job for us. That's the easy part. You don't have to be a genius to figure out what the consensus currently is, right? That's the easy part. You look at the data, you look at it objectively, and you see what consensus is. The hard part is to actually go against consensus, right? Because I can tell you from experience, when you're doing this alone, when you're an individual investor, you have the internet, you have Twitter, YouTube, a huge amount of noise, a huge amount of information overload with people that seem very confident about this consensus trade. It never feels right to go against that. And yet that's how we view the market. Personally, that's exactly what I think investors have to be able to do in order to be successful. It's to go against the herd when everyone's betting in one direction. And we know that's one of the biggest obstacles to the individual investor when it comes to investing, and that's why we have a research team that is dedicated to present the data objectively in a historical context, no gut feeling, no emotion, because that will lead you in the wrong direction. We want to give you guys the truth and the data-driven odds. We do have a free trial, so check out our website and see if our service is something you'd find helpful to gain an edge on the market. At the end of the day, our subscription is the cost of a nice dinner out, but with a lot more insight and a lot more value. And one final word on consensus. The most frustrating part is that consensus can actually end up being right for quite a period of time. And you can see that, for example, I'll give you October 2008 scenario. Big consensus trade is that we were seeing a financial collapse of the market. And of course, between October 2008 and March 2009, so almost 6 months of trading, the market continued to go down and looked incredibly bad when it was really bottoming. And that's a scenario where you look like a complete idiot for 6 months straight, and everybody's telling you that you're looking at the market completely wrong and that you should have paid attention to what everyone was saying. So that can be frustrating, and that's okay. If you're afraid to look like an idiot in the market, you're never going to be a good investor. So now let's address the important question ahead of this meeting, but not just this meeting, but also future meetings, because again, our strategy is a lot broader. It's 6 to 12 months. It's not based on one meeting, right? A temporary market reaction to such a documented event can really go either way. Question is the Fed going to get a lot more hawkish from here? And if we take a look at an article we posted on Friday last week, where we took a look at the CPI report, but we also discussed the Fed and where we are in the tightening cycle. If we take a look at this chart, we use the blue line here, that's the 10-year Treasury real yield, so adjusted for inflation. We consider that the financial conditions, right? How tight are financial conditions? And the black line is the neutral rate. It's a market proxy for the neutral rate, and the idea behind this chart is that if financial conditions, so the blue line, reaches the black line, you're at neutral. So monetary policy is not tightening, it's not stimulating, it's not doing anything. That's what the neutral is. If the blue line is above the black line, you're in a tight monetary policy. And you can see here between 2009 and 2015, monetary policy was very loose. So financial conditions being a lot lower than the neutral rate. And you can see where we are now. We have financial conditions that are at the same level as the neutral rate. And we can actually see the spread between the two, right? Do one minus the other, and this is what we get, right? And it's a beautiful chart that shows you when monetary policy is very loose, very easy. For example, in 1992, following the 89 recession, for example, right here in 2003, following the 2001 recession, or in 2009, following the global financial crisis. And here today, you can see we are at very, very tight conditions. So it is difficult here to make the case that they are going to surprise the market with a lot more hawkish tone that's a lot more aggressive than what they've had over the last few months. So we do think here this put-call ratio concerned about the Fed is completely wrong. Now the next big concern for the market now is going to be a recession, right? And you can see following tight conditions, for example, in 2006, 2089, recessions every time followed relatively quickly. Now that's a conversation for another day. We don't think a recession is imminent. It often takes 1 to 2 years before the tight conditions translate into a recession and an earnings collapse. Now the tightening of financial conditions we've had here, the rising short-term rate we've had throughout 2022, that's going to lead to a big earnings collapse down the road. It's going to lead to very likely a severe recession, but that takes time to trickle down in the economy. And we don't think that's coming until around mid-2023. We have written about that in this article right here, highlighting our entire thought process. If you haven't read this article and you want to understand the earnings dynamic today, I'll make sure to go ahead and do that. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget, smash that like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.